Hello, hi guys. How are you? Hope you people are doing well. Even I'm fantastic. So today I have brought before you terrific 20 concepts for CA Inter audit. See, here the concepts that I am going to discuss here, these are never tested by ICI, and there is a high chance that ICI will test these questions, if not in the Jan 26 attempt, even in the upcoming attempts also. ICI might test these questions or test these concepts that we are going to discuss now. So this particular video, which is terrific 20 concepts for Jan 2026, this is not only relevant for Jan 26 attempt. If at all ICI doesn't test these concepts in Jan 26 attempt, there is high chance that it will test in the upcoming attempts also. Understanding? So the relevance of this particular video is not restricted just for Jan 26 students. Got it? Yeah. So let us start the discussion of important 20 concepts in CA Inter audit. Got it? Yeah. So starting with the first chapter, concept number 1, engagement and quality control standards. So you might be knowing ICAI has issued various engagement and quality control standards. Of those engagement and quality control standards, the first series is auditing standards, right? Or you can call them as standards on auditing, which we will be seeing in our syllabus. Now, these auditing standards, they are applicable for audit of historical financial statements, correct? They are applicable for audit of historical financial statements. Now, what is meant by historical financial statements? The financial statements that you prepare based on past data, already occurred transactions, will be known as historical financial statements. For auditing such a historical financial statements, auditing standards are applicable. Understanding? Next, apart from historical financial statements, there is also prospective financial statements that I'll explain you. Next, after auditing standards, and another point, in case of audit, you will give reasonable assurance, correct or not? You will give reasonable assurance. Reasonable assurance means a high level of assurance, but not absolute assurance. Next, after auditing standards, the next series of standards that the ICI has issued are standards on review engagement, right? Standards on review engagement. Now, this is standards on review engagement are also applicable for review of historical financial statements only. Now, sir, auditing standards and standards on review both are applicable for historical financial statements only. But the first one is audit and the second one is review. Now, what is the difference between audit and review? The difference is, in case of review, you will provide only limited assurance. Limited assurance means, limited assurance is a assurance that is less than the reasonable assurance. The level of assurance that you will get in case of limited assurance is less than the reasonable assurance. So there are three types of assurances. Firstly, absolute assurance, which means 100% assurance. Next, you have reasonable assurance, which means high level of assurance but not absolute assurance. Next, you have limited assurance, which is the level of assurance which is lesser than the reasonable assurance, right? So auditor, he will provide a limited assurance in case of review. Now, why you are providing limited assurance in case of review? Because you are performing less number of audit procedures when compared to the audit. Since you are performing less number of audit procedures, you will get only limited assurance, right? Next you have standards on assurance engagements, which you will call them as SAE series. Sir, what is this standards on assurance engagement? See, if auditor provides assurance on historical financial statements, we will call it as audit, right? If auditor provides assurance on items other than historical financial statements, then you will call it as assurance engagement, and for that assurance engagement, standards on assurance engagement will be applicable. Understanding? So let's say for example, auditor wants to provide assurance on prospective financial information, prospective financial statements. Prospective means financial statements that are related to future. On that prospective financial statements, auditor wants to provide assurance, then he needs to apply standards on assurance engagement, SAE series. Or auditor wants to provide assurance on internal controls, then also he needs to apply SAE series, standards on assurance engagement. Got it? Yes. Next you have standards on, or you can say standards on related services, that is SRS series, standards on related services. So here, see, the audit firm, it will not provide only audit engagements or review engagement, it will also accept certain non-assurance engagement, like compilation of financial statements. Compilation means just to prepare the financial statements or filing income tax returns, which are non-assurance services in which you will not provide any assurance. For such kind of non-assurance services, standards on related services, SRS series is applicable. Understanding? So these are the four series of standards that ICAI has issued. Now, in all these types of engagements that the audit firm takes up, it needs to maintain utmost quality, correct or not? So in all the engagements or in all the services that the audit firm provides, quality has to be maintained. To ensure quality in all those services, ICAI has issued standards on quality control, nothing but SQC series. So in our syllabus we have SQC1, right? So these are the complete. So all these five together, you will call them as engagement and quality control standards. Got it? So this is the concept of the engagement and quality control standards. So whatever I have explained you, the same thing you will find here. So some of the examples for standards on auditing you already know: SA 200, SA 230, SA 705, all these things. Next, some of the examples for standards on review engagement. See, this SRE series you don't have in your syllabus, but at the final level we will be discussing this. Okay, so SRE 2400, SRE 2410, these are some of the examples. For SAE 3400, SAE 3420, and for SRS 4400, SRS 4410, and SQC1 you already know. So this is the first concept, which is engagement and quality control standards, right? Yes. Next, moving to the second concept, threats to independence. Now, first of all, what is meant by independence? What is meant by independence? Independence means independence means whatever decisions you take, that should not be subordinate to the will and wish of some other person. You should be independent, correct? You should not get influenced by the third party, that is known as being independent. Now, threats to independence means, threats to independence means, okay, threats to independence means any situation or any factor that causes the auditor not to be independent are known as threats to independence. Understand? So any factor or any cause that causes the auditor not to act independently will be threats to independence. There are basically five threats to independence. What are those five threats to independence that we will be discussing? Okay. So first threat, self interest threat. Self interest threat. Self interest threat means, see, let's say for example, you have prepared, sorry, uh, you have invested in the shares of a particular company, and you are also acting as auditor of that company. So here you are having interest in the business of the company, and you are also acting as auditor of the company. You cannot act independently because you are having some interest in that entity. So this is the best example for self interest threat. So if at all there are any such threats, what the auditor has to do, auditor has to implement safeguards, correct or not? So safeguards to eliminate that threats or reduce that threats to an acceptable level. Or let's say for example, another example for self interest threat, one of your relatives or your wife is acting as a director of that company, and you are doing audit of that company, this will also create a self interest threat. Understanding? Yes. So in most of the situation, this self interest threat arises because of monetary interest. Monetary interest. Understanding? You and the company, both of, okay, auditor and the company together doing some business, and you are acting as auditor of that company. Here also you cannot act independently because there is a self interest threat, because you and that company together are involved in a particular business. Understand? This is the first threat. Next, self review threat. Self review threat means you have done a particular work and you are only auditing that work, then it will cause a self review threat. Let's say for example, you have prepared financial statements. Preparation of financial statements is whose duty? It is a duty of management. But you as an auditor, you have prepared financial statements, and after preparing financial statements, you are only auditing that financial statements. Then what will happen, if at all, while auditing financial statements, if you found any misstatement, and if you tell to the management there is a misstatement in these financial statements, then what management will say? Are auditor, you only prepared that financial statements, like this the management will say, correct or not? So if you only done some work and you only auditing that work, it will create self review threat. You are reviewing your own work, in which you cannot act independently, correct or not? You will not be able to point out the misstatements or mistakes properly. This is a self review threat. Understanding? Next, familiarity threat. Familiarity threat means, let's say for example, you are acting as auditor of the company for the past 10 years. So for the past 10 years you are auditing means you would have already developed a relationship with the client. So when such a relationship has been developed, you will become familiar with the client. When you have become familiar with the client, you will not be able to identify misstatements. If at all any misstatements are identified, since there is a close relationship between you and the client, you will ignore that misstatements, correct or not? So here also you are not acting independently, which is nothing but a familiarity threat. Next, intimidation threat. Intimidation threat means client is threatening you that if you find any misstatements, if you give qualified opinion, I will remove you as an auditor. This is a intimidation threat where client is threatening, or you are having, you okay, auditor is having just some 1 year of experience, and client is having, or client is doing the business from the past 30 years. Now there is a particular accounting treatment which client has done wrongly. Now auditor has pointed out that, see client, this accounting treatment is wrong. Then client is saying that, see auditor, you are just having 1 year of experience. I am doing this accounting treatment like this only for the past 30 years. This is also intimidation. Client is intimidating the auditor with his experience. Understanding? So this is intimidation threat, self-interest threat, self-review threat, familiarity threat, intimidation threat, and still there is one more threat, which is advocacy threat. Advocacy threat. Advocacy threat means auditor is promoting the client. Let's say for example, client is going for IPO, initial public offering. Auditor has promoted the client in the public. See, public auditor is the client's business is very good, it is making lot of profit, it is having lot of opportunities in the future. Like this, the auditor is promoting the client with the public, so that more subscription will be received for the IPO. Now after the client has issued IPO, public has purchased the shares of the company based on the words that the auditor has told. Now after 2 years or 3 years, auditor came to know that company has done lot of frauds. Whatever the things the company has told in the prospectus, they are wrong. Just to get demand for the shares, they have told all those things. In such a situation, can auditor point out those mistakes, those frauds? Cannot. He cannot, because already he has promoted the client among the public. If now auditor only says that client has done lot of frauds, then public will question the auditor. At that time you have promoted a client na, like this they will question the auditor. So this becomes a advocacy threat. Since auditor has advocated, advocacy means promoting the client, since auditor has promoted the client to such an extent, now he is not able to act independently. Understand? So these are the threats to the independence of the auditor. Got it? Yes. Now if you have these threats, will you keep silent? No. You will try to eliminate these threats completely, or you will try to implement safeguards so that these threats can be brought to a acceptable level. Understand? Yes. That is the action that you will take. So some more examples you can find here in the book with respect to these threats. I have given one or two examples for each of the threat. Clear? Next, concept number 3 from essay 210, recurring audits. Now, see, generally, auditor, he will issue engagement letter to the client, correct? So, what will be there in the engagement letter? All the terms and conditions, so the scope of the engagement, objective of engagement, responsibilities of management, responsibilities of auditor, the format of audit report, all these things will be there in the engagement letter, correct? Now, there is this concept of initial audit and recurring audit. So let's say for the first year, Mr. A has been appointed as auditor. For the second year, Mr. B has been appointed as auditor. Mr. B has been appointed as auditor. Now, Mr. B, he is auditing the entity for the first time, because in the previous year, some other person has audited the audit of this particular company, and Mr. B is auditing this entity for the first time. So, this will become initial audit engagement. For Mr. B. Now, in the initial audit engagement, of course, you will give engagement letter to the client. Yes. Next, for the third year, for the third year, again, Mr. C was appointed as, or let's say, for example, for third year also, Mr. B only got appointed as auditor. Understanding? Now, this is a recurring audit for Mr. B because in the previous year also, Mr. B only did the audit, and in the current year also, again for Mr. B only, this audit engagement has been allotted. Correct or not? Now, in this situation, tell me whether Mr. B will give engagement letter again. Engagement letter, will it be given by Mr. B again? Because in the initial audit engagement in the previous year, he has already given the engagement letter. Whether in the recurring audit also, will he give the engagement letter? Tell me. The answer is it depends on certain circumstances. If auditor feels, if Mr. B feels that management in the previous year has not understood scope and objective of audit properly, then he will give, by detailedly writing down the scope again, he will give new engagement letter. Or if there are change in the circumstances, or if there is change in size nature of the entity, then also new engagement letter will be given. Or if there is change in the top management of the company, then also new engagement letter will be given. If there is change in the ownership of the company, then also new engagement letter will be given. Like this, based on the circumstances, if it is required to give new engagement letter will be given. Otherwise, if auditor feels that it is not required to give new engagement letter, he will continue with the old engagement letter itself. He will not give new engagement letter for the recurring audits. Understood? Yes. See, circumstances in which new engagement letter will be given: if auditor feels or there is an indication that entity misunderstood the objective or scope, there is a revised or special terms, if the terms of engagement itself have changed, then of course new engagement letter has to be given. Next, change in the senior management, change in the ownership, change in nature or size, change in regulatory requirements, change in financial reporting framework, or change in other reporting requirements. If there is change in any of these things, then new engagement letter will be given by the auditor. Right? Next, concept number 4: overall audit strategy. So, as per SA 300, auditor prepares overall audit strategy. Right? What is the difference between strategy and plan? Strategy answers what has to be done and when it has to be done, who will do it. But how it has to be done will be answered by plan. Right? Plan is more detailed when compared to strategy. Plan is prepared based on the strategy. Correct or not? Now, while preparation of overall audit strategy, what factors should be considered by the auditor? First of all, auditor needs to consider characteristics of the engagement. Characteristics of engagement means, see, characteristics of a person means whether that person is tall, short, black, white, whether he is having hair, huge, lot of hair or less hair. All these are characteristics of a person. Similarly, for the engagement also there will be characteristics like what is the financial reporting framework that is followed, and what are the reporting objectives. See, financial reporting framework, reporting requirements of that particular industry, nature of business segments, all these are the characteristics of engagement. Based on characteristics of engagement, overall audit strategy changes. So you should first of all understand, you should first of all focus on what are the characteristics of the engagement before developing the overall audit strategy. Next, what are the reporting objectives of the entity? That is the second thing that you need to consider. Reporting objectives of engagement. Reporting objectives means, see, generally for all the companies you will give audit report as per section 143. That is common. Now, along with audit report, is coro also applicable to this company? Is report on internal controls or financial reporting, is that report also applicable? And in case of banks, various reports will be applicable: LFR, long form audit report, report on interest subvention, like this. So based on the entity, the reporting objectives will change. So based on the reporting objectives, your audit strategy changes. Understand, if you have to report on a lot of things, you need to verify a lot of things. For verifying a lot of things, your strategy should, your the scope of audit in the strategy should include all those things, correct or not? So you should also consider reporting objectives. Some of the examples include entities timetable, discussion with management regarding type and timing of reports, organization of meetings to discuss the nature, timing, extent of audit, and communication among engagement team members. Next, another thing that you need to consider for preparation of overall audit strategy is in which direction the efforts of engagement team has to be focused. Generally, if in any area the ROMM, risk of material misstatement, is high, the engagement team efforts will be more on that area, correct or not? So, overall audit strategy has to be prepared focusing more on the areas where the engagement team efforts has to be focused, correct or not? So the third thing that you need to consider for preparation of overall audit strategies, in which area the engagement team efforts has to be focused on, that areas should be focused more in the overall audit strategy, correct or not? Yes. So some of the examples include volume of transactions or more. Okay, if volume of transactions in any area or more, then in that area the engagement team efforts should be directed more. Next, specific significant industry developments, significant changes in financial reporting framework, other significant relevant developments. These are some of the examples of areas where engagement team efforts will be directed more. Next, considering results of preliminary engagement activities. What is this preliminary engagement activities? See, for a development of overall audit strategy, you should also consider the results of preliminary engagement activities. If you remember, in SQC1 SA 220 we have discussed some preliminary engagement activities. That is, before accepting the engagement you will perform certain activities like verifying integrity of the client, right? And whether my engagement team is having proper knowledge, competent enough to perform the work or not. And if I accept the work, can I act ethically, can I comply with ethical requirements? All these are the preliminary engagement activities that you will perform. So the results of preliminary engagement activities should also be considered for developing overall audit strategy. And finally, ascertaining the nature, timing, extent of resources that are necessary to perform the engagement. These are the five factors that you need to consider while developing overall audit strategy. Audit, yes. Next, moving to the concept of audit risk, fifth concept. Now, what is this audit risk? Audit risk. Now, audit risk is a combination of inherent risk. Inherent risk means, let's say, for example, there is cash. Now, if there is a cash, then the inherent risk of cash is that it might be subjected to theft, correct or not? Inherent risk means the risk that is present by birth is known as inherent risk. Okay, so inherent risk of cash is someone can come and steal the cash. That is inherent risk of cash. Let's say, for example, in the area of cash, the inherent risk is some 50%. That means there is a 50% chance that, or there is a 50% risk that cash will be subjected to theft. Now, if there are these inherent risk, will you keep silent after knowing that cash will be subjected to theft? Will you be silent? No. What will you do? You will implement controls, correct or not? You will implement controls. So here in the area of cash control means CC camera you will implement. So you have implemented a control. Now is there a guarantee that CC cameras will detect or will prevent the risk completely? No, controls cannot prevent the risk completely. Let's say CC cameras have prevented some 75% of the inherent risk. So 75% of risk of cash being subjected to theft is prevented by CC cameras. Still there is a 25% risk as it is. So of the 50%, 75% is reduced. Okay, see, you need to observe, of the 50%, 75% is reduced from controls, balance 25% is there as it is only. So control risk is 25%. That means control risk means risk that controls might fail, risk that controls might not be able to detect, prevent, correct the misstatements is known as control risk. Now if you multiply this, you will get 50% multiplied by 25%, you will get 12.5%. Correct or not? Now there is a, see, the 50% inherent risk has been reduced to 12.5% with the help of controls. Correct. So this 12.5% you will call it as romum, eh, risk of material misstatement. That means risk of material misstatement is combination of inherent risk and control risk. Now this risk of material misstatement, it is not in the hands of auditor. Correct or not? By the time auditor has come to the entity, inherent risk is already there and control risk is also already there. So auditor cannot influence inherent risk and control risk. So risk of material misstatement is not in the hands of auditor. Understanding? Now when auditor starts his audit, he already determines acceptable level of audit risk. Let's say for example, auditor has determined acceptable level of audit risk as 2%. That means if overall audit risk is 2%, see, audit risk means the risk of giving inappropriate audit opinion. That means when there are misstatements in the financial statements, auditor needs to report those misstatements. But auditor not reporting that misstatements is known as audit risk. Auditor not identifying that misstatements is known as audit risk. Okay, auditor giving inappropriate audit opinion. So auditor is okay if audit risk is up to 2%, because audit cannot give 100% assurance, audit cannot give absolute assurance, it can only give reasonable assurance. So auditor felt that it is okay for me if audit risk is up to 2%. Now here risk of material misstatement is 12.5%. Now he has to reduce this risk of material misstatement of 12.5% to 2%. How he can reduce it? He can reduce it by performing audit procedures. Okay, he needs to perform that many number of audit procedures that will reduce the risk of material misstatement from 12.5% to 2%. Understanding? So now audit procedures that the auditor performs cannot detect all the misstatements. Correct or not? It cannot detect all the misstatements. Now the risk that auditors procedures will not be able to detect the misstatements is known as detection risk. Okay, is known as detection risk. Risk that auditors procedures cannot detect the misstatements is known as detection risk. Now this detection risk is in the hands of auditor only. If he performs more audit procedures, detection risk reduces. If he performs less audit procedures, detection risk will increase. Correct or not? Now he will bring the 12.5% risk of material misstatement to 2% by this by adjusting this detection risk. So audit risk, how we will reduce it? Audit risk he want to achieve is 2%, right? Audit risk is a combination of inherent risk, detection risk, control risk. Now auditor already know what is the inherent risk and detection risk combination. It is 12.5% and multiplied by control risk. Now control risk will be, how much will be the control risk? 2% divided by 12.5%. How much it will come? I don't have calculator. Okay. 2 divided by 12.5 into 100 is equal to 16%. So his detection risk should be 16%. That means 74 or 84% of the misstatements should be identified. Okay, 84% of risk of material misstatements should be identified. Balance 16% detection risk. Okay, if the detection risk is 16%, then 12.5% multiplied by 16%, it will become 2%. So if detection risk is 16%, then his audit risk reduces to 2%. Understood the concept? So this is the concept of audit risk, and this is how different components of audit risk will work. Understood? Yes. So the same thing you can find here as a explanation. Another thing, this detection risk is there now. This detection risk, you can further classify it into sampling risk and non-sampling risk. The sampling risk, it will be discussed in SA 530. See, if you are taking a sample, then you are not verifying a complete information, complete population. Based on sample, you are arriving at a conclusion on population. So of course there will be some unidentified misstatements in the complete population, as you are not auditing complete population. So this risk that you are taking because of auditing of the sample, because of taking the sample, is known as sampling risk. Understanding? Yes. And the risk genuinely because of the audit procedures that you perform will be non-sampling risk. So combination of sampling risk and non-sampling risk will be detection risk. Understood? Yes. So that is concept number 5. Next, concept number 6, factors to be considered while determining the benchmark. So what is this benchmark? See, for determining materiality, how will you calculate materiality? Materiality calculation, benchmark multiplied by a percentage. Correct or not? Now how will you select this benchmark? Examples of benchmark: sales, net profit, gross profit. All these are some of the examples of benchmark. Correct? Now how will you select this benchmark? For selection of a benchmark, you need to consider certain factors, certain things. What are they? Firstly, what are the items or elements of financial statements? You need to see that, okay, the sales, net profit, purchases, loans. So all these elements of financial statements will be there. You need to see what elements are there in the financial statements, because from that elements only you will select one element as a financial, one element as benchmark. Correct or not? Next, you need to see on which items of the financial statements the users focus will be more. Okay, on which items of the financial statements users will focus more. that items you need to select, correct or not? So let's say for example, in case of banking companies, users focus will be more on the area of loans. So in case of a banking company, it is better to select loans as benchmark, correct or not? So the second thing that you need to consider is on which items, on which elements users focus will be more. Okay. Next, the benchmark that you shall select, it should not be volatile. Okay, a high volatile element you should not select as benchmark. You should select non-volatile item as benchmark. Volatile means highly fluctuating. Okay, let's say sales of the entity in 1 year it is 1 crore, in the next year it has fallen to 10 lakhs, in the next year it has fallen to 20, it has went to 20 crores. If the item is highly volatile, highly fluctuating, you should not select that such type of an item as benchmark. Understanding? So like this, some factors are there. Let's see. Elements of financial statements, where there are items on which attention of users will be focused more. Nature of the entity also you need to consider. So in case of a trading entity, you will take sales as benchmark. In case of banking, you will take loans as benchmark. In case of manufacturing, if it is profit oriented, you might take net profit. Understanding? So like this, based on the entity, the element or the benchmark that you will take will be changing. Next, you should also consider entity's ownership structure and the way it is financed for selecting the benchmark, and the relative volatility of benchmark. So the benchmark should be less volatile. Understanding? Yes. Next, concept number 7. Factors to be considered in determining whether deficiency constitutes a significant deficiency. Deficiency in what? So basically, internal controls. Internal controls. So if internal control is not working as expected, okay, if internal control, there is any deviation in the internal control, then you will call it as deficiency in the internal control. Or required internal control is not at all there, it is not at all in existence, then also you will call it as deficiency in the internal control. So if there are these deficiencies in the internal control, see, as per SA 265, auditor needs to report significant deficiencies. Significant deficiencies, deficiencies in internal control. Okay, auditor needs to communicate significant deficiencies in the internal control to those charged with governance. Now, which deficiency will be considered as a significant deficiency? To identify that, there are certain factors that the auditor needs to take into account to determine significant deficiency in the internal control. See, the likelihood of deficiencies leading to material misstatements. So there is a deficiency in the internal control, and because of that deficiency, there the misstatements can occur in the financial statements. Then you can call that deficiency as a significant deficiency, because of the deficiency misstatements are occurring. Okay, the chance of occurring misstatement is very high, then you can call such a deficiency as significant deficiency. Next, susceptibility to loss or fraud. If there is a deficiency in the in the internal control, and because of that deficiency there is a high chance of loss or fraud occurring in that area, then also that deficiency might be termed as a significant deficiency in the internal control. Next, subjectivity and complexity of determining estimated amounts. Subjectivity means emotions of a person. Okay, so subjectivity means, let's say for example, provision for doubtful debts. While making for provision for doubtful debts, subjectivity is involved. If you ask person A to make provision for doubtful debts, he might say that in the future 20 lakhs debtors will become bad debts. If you ask same thing person B, he might say that not 20 lakhs, 10 lakhs debtors only will become bad debts. So this is a subjective decision. So subjective decisions will vary from person to person because they are not based on facts, understanding. So if subjectivity and complexity is involved in estimating a amount, and the controls around that amount are not working properly, then also you can call that controls as significant deficiencies, understanding. So for making a certain estimation, let's say estimation regarding provision for doubtful debts, for making that estimation, lot of subjectivity is involved. Okay, lot of subjectivity is involved, and controls around this area are deficient. Okay, there is deficiencies in controls around this area, then you can call these deficiencies as significant deficiencies. Okay, significant deficiency, because the estimations involved here are subjective. Okay, since subjectivity is involved, and around that subjectivity area controls are deficient, it can lead to significant deficiency, understanding. Next, financial statement amounts exposed to deficiency. See, if huge amounts are exposed to deficiency, let's say for example there is some rental expenditure of some 2 lakh rupees per entire year, and there is salary expenditure of 2 crore rupees per entire year. Now around this rental expenditure there is deficiency in the control, around this salary expenditure also there is deficiency in the control. Now which deficiency will become significant deficiency? Of course this deficiency becomes significant deficiency because the amounts that are exposed to the deficiency are more, correct or not? So this factor also should be considered by the auditor in determining significant deficiencies. Okay, the amounts that are exposed to the deficiencies. Next, volume of activity that has occurred or could occur, same thing. Let's say here rental, so rentals will be for 12 months, 12 transactions will be there here. Let's say this, instead of salaries, let us make it as sales. Now sales will be lot of transactions every day, some hundreds of sales will be happening. Let's say some 1 lakh number of sales transactions are there. Now volume of sales is more, and in that area of sales controls are not working properly, this becomes a significant deficiency when compared to controls over rental, understanding. Because the rental transactions are only 12 transactions, the volume of transactions is less, and that less number of transactions are subject to deficiency in the control, that deficiency might not become significant deficiency, understanding. Yes. Next, interaction of deficiency with other deficiency, there is a possibility that there is a deficiency of control in two areas. Now individually they are insignificant only, but if both of them combine, that might become significant deficiency, understanding. That also you need to consider whether two or more deficiencies combining and becoming significant deficiency. Clear? Yes. See, auditor just need to consider these factors. If any of these factors are there, then there might be a chance that such a deficiency might become significant deficiency. It is not 100% rule that if these factors are there, for sure that deficiency is significant deficiency. No, if these factors are there, there is a chance that that deficiency in the internal control might be significant deficiency. Got it? Yes. Next, concept number 8. Determining the type of audit opinion. See, the let me tell you, audit opinions are there, no? Audit opinions. Now, this audit opinions, you can classify them into unmodified opinion and modified opinion. Unmodified, when will you give, if there are no misstatements you will give unmodified opinion, if there are misstatements you will give modified opinion. This modified opinion is also again of three types, correct? What are they? Qualified, adverse, and disclaimer. Now, how should you decide in which situation which type of opinion has to be given? When should you give qualified opinion? When should you give adverse opinion? When should you give disclaimer of opinion? For this determination, I will give you a chart. Remember, see, basically this determination of qualified, adverse, disclaimer, which opinion has to be given. For this, you will consider three factors. What are those three factors? First of all, you will see whether audit evidence is available, that is availability of audit evidence. This is the first factor that you will see. Next factor that you will see, based on audit evidence, if you have identified any misstatements, are those misstatements material? Okay, you will see materiality of the misstatements. Materiality of misstatements. So these are the first two factors: availability of audit evidence, materiality of the misstatements. Third factor that you will see is pervasiveness of the misstatements. Pervasiveness. Now, what is meant by pervasiveness? If misstatements are spread across many items, then you will call it as pervasive, correct or not? So, if misstatements are there in many areas, many items, then you will call it as pervasive, spread across many items. Understanding? So, these three factors you will consider for determining type of opinion. Let us start determining the type of opinion. Type of opinion. Now, if audit evidence is available, yes, audit evidence is available, and if at all there are any misstatements, that misstatements are material but not pervasive. In this situation, you will give qualified opinion. Clear? Next, there is next situation, there is no audit evidence, but if at all there are any misstatements, that misstatements will be material but not pervasive. In this situation also, you will give qualified opinion. Okay. Next, coming to third situation, there is audit evidence available. Okay, audit evidence is available, that misstatements are there, and those misstatements are material and also pervasive, then you will give adverse opinion. Okay. Next next, there is no audit evidence available, and even though there is no audit evidence available, auditor feels that if at all there are any misstatements, that misstatements will be both material as well as pervasive. In such a situation, auditor will give disclaimer of opinion. Disclaimer means not claiming any opinion. Okay, not claiming any opinion is known as disclaimer of opinion. Why you are not claiming any opinion? Because you are not having any evidence. If you are not at all having any evidence, how can you claim a opinion? How can you come to a opinion? Understanding? So here you are giving disclaimer of opinion, not claiming any opinion. You can ask, sir, here also you are not having any evidence now, why you are giving qualified? Because even though there are no evidence available, auditor feels that lot of misstatements are not present. Okay, misstatements are not pervasive, so you are giving qualified. But in this fourth situation, misstatements are also, lot of misstatements are there, misstatements are pervasive, so you are giving disclaimer of opinion. Understood? So this is how you will have to determine the type of modified opinion that should be given by the auditor. Clear? Yes. So whatever I have explained you, the same thing you will find it here. Next, concept number 9, which is related to Coro. Clause 2 of Coro. So clause 2 of Coro deals with inventory. Correct or not? So first of all, I'll read the clause 2, then I'll explain you. This clause 2, there are some points that you need to focus. See, whether physical verification of inventory has been conducted at reasonable intervals by management, and whether in the opinion of auditor, coverage and procedure of such verification by management is appropriate. So auditor, as per clause 2 of Coro 2020, he needs to report whether physical, see, don't skip, there is one important point in this particular clause 2. I'll explain you that point. Okay, so auditor needs to report whether physical verification has been done by the management properly, and in that physical verification any discrepancy is noticed, that needs to be reported by the auditor. Okay, whether that discrepancy is properly accounted for in the books of accounts or not. Okay, 10% or more, they will say. See, during such verification, whether any discrepancies of 10% or more in aggregate for each class of inventory, you need to observe this term, class of inventory, for each class of inventory were noticed, and if so, whether they have been properly dealt with in the books of accounts. Now see, they are saying inventory, the two class wise, what will be different classes of inventory? There could be raw material, right? There could be work in progress, there could be finished goods, right? Now class wise, inventory that is present in books of accounts and inventory that is present in physically. Okay, physical inventory. So if there is a discrepancy of 10% or more between these two, okay, so let's say raw material as per books of accounts is 10 crore, but physically the raw material is 12 crores. Now 10% of 10 crore, it becomes, see this 10% you need to calculate it on value as per books of accounts. Okay, 10% of 10 crore, it becomes 1 crore. Correct? Now the difference, sorry, this is not 12%, 12 crore, 12 crore. Okay, the physical value of inventory is 12 crore. Now the difference between 10 crore and 12 crore is 2 crore, right? How much is the discrepancy? Discrepancy is 2 crore. 10% of 10 crore is 1 crore only, so this discrepancy is more than 10%, so this will be reported. Understanding? Next, work in progress is, as per books of accounts, work in progress is 11 crore, and as per physical verification also work in progress is 11 crore only. Next, finished goods, as per books of accounts, finished goods is some 20 crore, but as per physical verification the value of finished goods is some 19 crore. Here The difference is 1 crore. Is this a difference of 1 crore more than 10%? No, this is less than 10%, because 10% of 20 crore, how much it will become? 2 crore it will become, but the difference is 1 crore only. So this is less than 10%. So this will not be reported. Understanding? Like this, you have to see class wise. You should not see like totals, you should not see 10 crore plus 11 crore, 21 crore, 41 crore, and this side 10, 20, 30, 40, 42 crore. Now 10% of 41 crore, it will become roughly 4 crore, and difference between 41 crore and 42 crore is only 1 crore. This 1 crore is less than 10%, so we should not report completely all these things. No, like that you should not see. Okay, you should not see total wise, you should see class wise. Understanding? Yes. So this is the important point under clause 2. They haven't tested on this point, they might test you. Clear? That is clause 2, subclause A, subclause B. Whether during any point of time during the year, company has been sanctioned a working capital limit in excess of 5 crore. So during the year, if a company is having any outstanding working capital loan of 5 crore, working capital will be sanctioned against the security of stock and debtors, right? Every month the entity has to submit a stock statement. Now here in this situation, auditor needs to report whether stock statement submitted by the entity to the bank is in agreement with the books of accounts or not. Whatever the stock that the entity has shown in the stock statement to the bank, is that stock matching with the books of accounts or not, that needs to be verified by the auditor, and he needs to report in this particular clause number 2. Got it? Yes. Next, concept number 10, which is audit trial. Now, what is meant by audit trial? Very simple. So, every entity, it will maintain books of accounts in a accounting software. Correct or not? Through a accounting software, it will maintain books of accounts. Now, audit trial is a feature of this accounting software. Understanding? Now what this audit trial will do? Audit trial will maintain a log, it will maintain a record of who have passed the entries in the books of accounts, when, at what date these entries have been passed, at what time these entries have been passed, and who have altered these books of accounts. All these things will be tracked by the audit trial. Okay, a log, a record of all these things will be maintained by the audit trial feature. Now companies act told that all the companies should have this audit trial feature mandatorily for their accounting software, and this audit trial feature should be switched on for 24 by 7. Okay, continuously this audit trial feature should be switched on. Companies, they should not switch off this audit trial feature of their accounting software. Understanding? So this is the audit trial. Now this audit trial is having some advantages. What are the advantages of audit trial? First of all, tell me, is this audit trial a internal control? Of course, audit trial is a best example for internal control. Correct or not? It is keeping a track of who has passed the entries, who have altered the entries. So this audit trial will ensure that no one will alter the entries, because if we alter the entries, if we wrongly alter the entries, audit trial will record, we will be caught. Such a fear will be there in the people, so with that fear they will not alter. So audit trial is a best example for internal control, and audit trial will enhance the internal controls. Correct or not? And audit trial will also fix the responsibility on the people, because audit trial will track, it will record who has passed the entry. If that entry is wrong, in future you can question that person, because from audit trial you can get to know who has passed that entry. Next, If at all any problem has arisen, you can rebuild the entries from the starting onwards. Okay, how that the history of the entry you can track if at all any problems have arisen, right? So audit trail analysis can specify reason for the problem, and audit trail will also help to help the system to operate as intended. So all these are the benefits of audit trial. However, this audit trial involves certain cost. An accounting software which have this audit trial feature will be costly when compared to a normal accounting software. And even for analyzing the audit trial data requires some time, correct or not? So certain time and cost is involved in this audit trial feature. Got it? Yes. Next, next concept number 11, controls over external confirmation procedure as per SA 505. See, now in case of debtors, creditors, auditor can verify that existence of creditors or debtors through external confirmation procedure, correct or not? Now, in this external confirmation procedure, auditor should exercise control on this external confirmation procedure. He should not assign this task of sending external confirmation to some third party or to the internal auditors. Basically, as per SA 610, using the work of internal auditors, external auditor can use the work of internal auditor. See, they can ask you a question linking SA 505 and SA 610. How they can ask? Like this only. So, as per SA 610, external auditor can use the work of internal auditor through direct assistance, right? Now, they will ask whether external auditor, as per SA 505, he has to send external confirmation. Now, for sending that external confirmation, can he use the work of internal auditor as per SA 610? Like this, they will ask. You should say no. External auditor should not or cannot use the work of internal auditors. Why? Because SA 505 says that external auditor should have complete control over external confirmation procedures, like selecting the persons to whom external confirmation has to be sent. That should be that persons should be selected by external auditor only. Which for which items, okay, for which data the external confirmation has to be sent, that should also be selected by external auditor only. Next, designing the external confirmation request, it should be designed by external auditor only. Understanding? Next, sending that external confirmation, sending a follow-up request, all this should be done by external auditor only. He should not assign this particular task. See, external auditor shall maintain control over determining the information determining the information to be confirmed. So whether amount should be confirmed or existence of a transaction should be confirmed, which amount, which item should be confirmed, determining that item should be determined by the external auditor only. Next, selecting appropriate confirming party means the third party to whom the external confirmation has to be sent. Understanding? See, in the entity there will be 1,000 debtors will be there. Understanding? From these 1,000 debtors, to whom external confirmation request has to be sent, that should be determined. Okay, selection of debtors should be done by auditor only. Next, in this debtors company there will be lot of people. There will be accountant, there will be manager, there will be CEO, there will be CFO, to whom that request has to be sent, whether it has to be sent to accountant, whether it has to be sent to managing director, to whom that request has to be sent, confirming party, that should also be decided by auditor only. Next, design of a confirmation request should be made by the auditor only. Next, sending the request including follow up request should also be done by auditor only. So on all these aspects, external auditor, that is statutory auditor, should have control. He should not assign this task to some other persons. Got it? Yes. Next, assembly of final audit file, concept number 12. See, once you have given audit report, basically this discussion it is made in essay 230, audit documentation. Okay, this concept that we are discussing is from audit documentation. Now, once you have given audit report, okay, let's say you have given audit report on 30th May. Now from here, within 60 days, within 60 days you have to finalize audit documentation. Okay, assembly, or you can say as assembly, assembly of final audit file should be completed. So maximum 60 days time is given. Within 60 days from the date of audit report, the assembly of final audit file should be completed. Next, this audit file which you have assembled, that should be retained by you for a period of 7 years from the date of audit report. Understanding, this is the retention period of audit file. So retention period is 7 years, and within 60 days you need to complete the assembly of audit file. Now while assembling the audit file, you should not make any changes to the existing audit documentation. Understanding, you should not add any new audit documentation during this assembly process. But however, you can make some administrative changes. Okay, some administrative changes can be made to audit documentation. What are these administrative changes? Like deleting draft documents or superseded documents. Superseded document means nothing but draft documents. While preparing a final document, you will be having various draft versions. Removing that draft versions you can do, that is a administrative process. Understanding. Next, another administrative process is the signing of the checklist. Now what documents has to be kept in the audit file? For this there will be a checklist. Okay, whether all those documents have been kept in the audit file or not, that will be checked, and that checklist will be signed. So signing that checklist can be done. Next, cross referencing the audit documentation, sorting the audit documentation, right, collating the audit documentation and pinning those audit documentation together. All this also comes under administrative changes which you can do during the final audit assembly process. Next, including some audited documents which were agreed and discussed among the audit team before the date of audit report. Okay, before the date of audit report only you have obtained some audit documentation and it is agreed among all the team members, but by mistake you have forgot to keep them in the audit file. Those types of documents also you can keep. All these they come under administrative changes. Understanding. So see, 60 days time limit, 7 years retention period, and if you wanted to make any changes to this audit documentation after the assembly of audit documentation is done, then you need to document why you are making that change and who are making that change. So see, specific reasons for making the changes, when and by whom those changes are made. But in case of administrative changes, you can make that administrative changes during the final assembly process, which include deleting or discarding superseded documents. Superseded documents means draft versions, sorting, collating, cross-referencing, signing of the checklist, documenting audit evidence that the auditor has obtained, discussed and agreed with the relevant members of engagement team members before the date of auditor's report. All these they come under administrative changes. Next, concept number 13, which is audit procedures when events or conditions are identified from SA 570. SA 570 deals with going concern, right? In going concern, there are certain financial events, operating events, or you can call financial conditions, operating conditions, and other conditions or other events. Now, if those events are there, then there is a chance that entity might not be able to continue as a going concern, right? So if auditor has identified any of that events, then auditor needs to determine whether there is a significant uncertainty that entity will not be able to continue as a going concern or not. See, once auditor has identified those events, either operational events or financial events, right? We have discussed financial events. Creditors stopped giving credit to the company, right? Or adverse financial ratios, company stopped giving dividend. All these are financial events that might cause a doubt on the entity's ability to continue as a going concern, right? Now once such events are identified, auditor needs to see. Yeah, sorry for the disturbance, guys. Actually, I got a phone call, so I have to attend it. So we were discussing these events that may cast significant doubt on the entity's ability to continue as a going concern, right? So once these events are identified, auditor what he will do is he will see whether there are any significant uncertainty with respect to going concern, right? Now if he finds that there is a significant uncertainty with respect to going concern, uncertainty means not 100% sure whether entity will be able to continue as a going concern or not. In such a situation, what procedures auditor has to perform? First of all, auditor should ask the management, have you performed going concern assessment? Because it is responsibility of the management to assess whether the entity will be able to continue as a going concern or not. So you have to ask the management, have you performed a going concern assessment? If you have not performed, request the management. Okay, if management has not performed the going concern assessment, auditor has to request management, please first of all perform going concern assessment. Okay, requesting management to make its assessment of going concern. Now there is a uncertainty with respect to going concern, right? Now what plans management has made to overcome this uncertainty? You need to ask, you need to evaluate the plans made by the management, the future course of action of the management, and whether those plans can be implemented, feasibility of implementation of those plans. See, evaluating management's plan for future action, whether the outcome of these plans is likely to improve the situation, and whether management's plans are feasible in the circumstances. Next, sometimes what the management will do is, see auditor, even though there are conditions, even though there are events that may cast significant doubt on entity's ability to continue as going concern, we are having sufficient cash flows. See, this is our cash flows. We are having sufficient cash flows. With this cash flows, we will be able to pay the liabilities. So we will be able to continue as a going concern. Like this, management may prepare a cash flow statement and submit to the auditor. Now, if such a cash flow forecast is prepared, while verifying that cash flow forecast, auditor needs to evaluate reliability of underlying data, and also is there proper adequate support for the assumptions that the management has made with respect to this cash flow forecast. Understanding? And finally, consider whether additional facts or information have become available since the date on which management has made its assessment. Let's say, for example, management has made assessment of going concern on some 6th of May 2026. Auditor is giving his audit report on some 10th of July 2026. Now, management has made its going concern assessment on 6th May 2026 based on circumstances, that are present at that particular point of time. Now, by the date auditor is issuing the audit report, the circumstances would have changed, right? So, based on the changed circumstances, will the entity be still able to continue as a going concern? That needs to be assessed by the management, whether any additional events or facts have been identified after the date on which management has made its assessment. Next, request written representation from management, and where appropriate those are with governance regarding their plans for future action. Now management told that we will take this particular future action, we are having this plan to overcome that uncertainty, right? Now auditor needs to ask management, okay management, you are saying you are having plans, give me in writing, give me a written representation that you will be able to implement these particular plans in the future. Understanding? Yes. So those are the audit procedures you will perform when events or conditions are identified. Next, concept number 14 from essay 299, audit conclusions and reporting. Essay 299 deals with joint audit, right? So here in case of joint audit, let's say for example Reliance Industries. Now for Reliance Industries, two or more auditors have been appointed as auditors, joint auditors. So Mr. A, Mr. B, Mr. C. All the three auditors together, they have been appointed as joint auditors. Now, should they give single audit report or should they give individual audit report separately? Tell me. It depends. So, if all the joint auditors have arrived at same opinion, okay, all the joint auditors wanted to give unmodified opinion, then all of them, they will give single audit report, right? Let's say for example Mr. A and Mr. B, these two wanted to give qualified opinion, but Mr. C wanted to give unmodified opinion. In this situation, Mr. A and Mr. B together they will give one audit report. Mr. C alone will give one audit report. Understanding? Now, in the audit report given by Mr. A and Mr. B, they should mention other matter paragraph. In the other matter paragraph, they should say that there is another auditor, another joint auditor, Mr. C, who has given a separate audit report. You please refer to that separate audit report also. Like this, it should be mentioned. Even in the audit report of Mr. C also, a paragraph, other matter paragraph should be there, and he should make reference to the audit report issued by Mr. A and Mr. B. Like this reference has to be made in the other matter paragraph. This is with respect to reporting aspect of in essay 299, joint audit. Next, concept number 15, engagement quality control review from SQC 1 and essay 220, right? EQCR. EQCR will be shortly calling it as, right, engagement quality control review. Now, what is this engagement quality control review? First of all, it is applicable only for the listed entities, right? It is applicable only for the listed entities. Now, in case of listed entities, let's say for example, again, we'll take example of Reliance Industries only. Reliance Industries. Now, let's say Mr. A has conducted audit of Reliance Industries. Okay, he has done complete audit and he is about to give his audit report. He has not yet dated the audit report. He is about to prepare his audit report. Before preparing the audit report, engagement quality control reviewer, okay, EQC reviewer should be appointed, and this engagement quality control reviewer should review the work done by Mr. A. Whatever the audit that Mr. A has done, that should be reviewed by engagement quality control reviewer. We will call this process of review as engagement quality control review, which is applicable only for the listed entities. Clear? Now, some important points with respect to engagement quality control reviewer are: this EQCR must be a chartered accountant, because he is verifying a work of a chartered accountant. So he should be a chartered accountant in order to be in order to act as EQC reviewer. And he can be, see, this EQC reviewer can be a person within the firm or outside of the firm, okay, or a person outside of the firm. Next, it is the responsibility of Mr. A, okay, it is the responsibility of engagement partner. We will call Mr. A as engagement partner. Now, it is the responsibility of engagement partner to ensure that for his audit, engagement quality control reviewer has been appointed, and this engagement partner should not give the audit report until and unless EQC review has been completed. Got it? So these are some points or some discussion with respect to engagement quality control review. See, if you see for audits of financial statements of listed entities only, this is applicable. The engagement partner shall determine that EQC reviewer has been appointed, discuss significant matters arising during the audit, and engagement partner should not date auditor's report until completion of engagement quality control review. Got it? Yes. Next concept number 16, attributes of finance lease. So if you see, leases are of two types. What are the two types of leases? One is finance lease, right? Another one is the operating lease, right? So in case of lease, generally the parties will be, there will be a property, right? And the person who takes this property on lease will be known as lessee, and the person who gives this property on lease will be known as lessor. Correct? Now, in which situations you will call the lease as a finance lease? What are the features of a finance lease? There are basically four features. First feature, the first feature is that at the end of the lease term, lessee will have option, see, will have option to purchase the asset, and the purchase price of the asset will be so less that lessee will exercise that price, exercise that option to purchase the asset. Understanding? So let's say lease tenure is some 10 years. After 10 years, there should be option present in the lease agreement, whereby by using that option, lessee can purchase that asset from the lessor, and the price that will be charged by the lessor for that sale will be so less, so tempting that lessee will for sure 100% purchase that asset at the end of the lease period. Got it? This is the first feature. Second feature, lease tenure should cover the complete significant portion of life of asset. Okay, so significant life of asset is covered by lease tenure. That means, let's say the life of asset is some 20 years. Okay, life of asset is 20 years, and lease of this asset has been given for some 16 years. So significant portion of life of asset is covered by the lease tenure. This is the second feature. Got it? Next, third feature, the present value of lease payment equals to value of asset as on this particular date. So every year lessee will pay lease rentals, right? Year 1 lease rental, year 2 lease rental, year 3 lease rental, year 4 lease rental, year 5 lease rental. Like this every year he will pay lease amount. Now if you bring that all lease payments to the present value, okay, to the present value, the value of the asset as on this date, okay, this present value of lease payments will be equal to the, almost equal to the value of asset as on this date. Understanding? So value of, if you bring all the future lease payments to the present value, it will be equal, almost equal to the value of asset as on today. Understand? That is the third feature. And fourth feature is that asset should be of specialized nature. That means the asset nature is such that it can be utilized only for the lessee's business. That asset cannot be utilized for any other businesses. It will be utilized only for the type of business that the lessee is doing. So it is of a specialized nature. Assets nature is of a specialized nature. If all these four features are present, you will call the lease as finance lease. If these four features are not present, you will call it as operating lease. Got it? Yes. So the same four attributes or the four features you can go through. Next, advances under consortium from bank audit. So what is meant by advances under consortium? So let's say, for example, there is a particular company, A Limited. A Limited wanted loan of some 1,000 crores. It has approached SBI Bank. SBI Bank, I wanted a loan of 1,000 crores. Like this, A Limited has approached SBI Bank. Now, the amount involved is huge, 1,000 crores. If SBI Bank alone gives 1,000 crores, a lot of risk will be involved to SBI Bank, right? So, what SBI Bank will do is SBI Bank will ask HDFC Bank, ICICI Bank, Axis Bank to contribute this loan amount, wherein SBI Bank will give 400 crores and HDFC Bank will give 200 crore, ICICI will give 200 crore, and Axis will give 200 crore. Like this, all these banks coming together, they will give loan to A Limited. This is known as advances under consortium. Understood? Now, in this advances under consortium, more share is contributed by SBI Bank, 400 crores. So SBI Bank will be called as lead banker. Okay, now all the documentation aspect will be taken care by lead banker, and every month A Limited has to pay EMI. That EMI will also be collected by lead banker only. Understanding? Let's say EMI that A Limited has to pay every month is some 50 lakhs. Okay, some 50 lakhs EMI has to pay for entire 1,000 crores. Understanding? So that entire 50 lakhs A Limited will pay to SBI Bank. 50 lakhs will be paid to SBI Bank. Now, SBI Bank has to give the EMI portion of HDFC Bank to HDFC Bank. Okay, from this 50 lakhs, whatever portion of EMI belongs to HDFC, that has to be given to HDFC. Whatever portion belongs to ICI, that has to be given. Whatever portion belongs to Axis, that has to be given. And remaining EMI, SBI Bank has to keep it. This is a procedure, how it will work. Now, A Limited has given complete EMI to SBI Bank, but SBI Bank did not give that portion of EMI to the remaining banks. Okay, SBI Bank has not given that EMI portion to remaining banks, and it's been more than 90 days. It's been more than 90 days. Still, the outstanding EMI is not paid. Then, in such a situation, see, A Limited has paid the money. A Limited, the complete EMI portion he has paid to SBI. There is no default on A Limited. But SBI failed to pay that amount to ICICI, HDFC, Axis Bank. In this situation, since it's been more than 90 days, HDFC Bank should treat this 200 crore as NPA. ICI also treat as NPA. Axis also treat as NPA. Understood the situation? Yes. So this is the point that you need to remember. In case of consortium loans, if lead banker does not pay the EMI portions to the remaining bankers, to the remaining member bankers, then member banks has to treat that loan as NPA in its books of accounts if it has crossed more than 90 days. Got it? Yes. This is with respect to consortium advances. Next, agricultural advances, concept number 17, again from this particular audit of banks only. Agricultural advances means those advances that are given for agricultural purposes will be called as agricultural advances. Now, generally, in case of normal advances, the NPA norms are, if the amount is outstanding for more than 90 days, you will treat it as NPA. But in case of agricultural advances, that 90 days rule should not be applied. Instead, there is a concept of, see, NPA norms in case of agricultural advances. Agricultural advances. So, agricultural advances, they can be divided into two. One is short term agricultural advance, long term agricultural advance, or you can call it as short duration crop. Okay, short duration crop, long duration crop. Okay, so what is short duration crop, what is long duration crop? If crop season, okay, crop season is less than or equal to 1 year, you will call it as short duration crop. What is meant by crop season? See, from the point you sow seeds in the earth and till the time you harvest the crop, that duration will be known as crop season. Okay, if that crop season is less than or equal to 1 year, you will call it as short duration crop. If that crop season is more than 1 year, you will call it as long duration crop. Now, in case of short duration crop, okay, in case of short duration crop advances, if EMI is outstanding or loan amount is outstanding for more than two crop seasons, then it will be termed as NPA. In case of long duration crop, if EMI is outstanding for more than one crop season, it will be termed as NPA. Now, how much will be the crop season for each type of crop? That will be decided by a committee. There will be state level committee board will be there, that will decide what will be the duration of each type of crop. For paddy, what is the crop season? For wheat, what is the crop season? For tobacco, what is the crop season? Like this, crop wise crop season will be already fixed by the bankers committee. Okay, as per that you will determine. Okay, see, state level bankers committee will determine the duration of a crop. Got it? Yes. Next, audit in an automated environment. See, this particular chapter, audit in an automated environment, it is part of risk assessment in your ICA study material. At the end of the risk assessment chapter, you will have this particular concepts related to audit in automated environment. For sure you will be getting questions from this audit in an automated environment. So I have kept that all those concepts in a separate chapter by name audit in an automated environment. Okay, so, in this audit in automated environment, concept number 18, risks arising from use of IT systems. So, because of use of information technology, what risks the organization can face? See, first risk is inaccurate processing of data. That means wrongly processing the data. If you wrongly code the system will process the data wrongly, or processing of inaccurate data itself. Understanding, that means data itself is wrong. System might process wrong data itself. Got it? So this is the first risk. Next, unauthorized access to the data. Next, risk of direct data changes. So directly someone can come and change the data in case of data is maintained in information system, right, in computer system. Next, excessive access or privileged access. Excessive access means you have given one of the employee more access to the system than that is required for his work, then there is a chance that he might misuse that excessive access that has been given to him, correct or not? So this is also one of the risk. Lack of adequate segregation of duties. So in case of information technology environment also, you need to segregate the duties among various employees. If there is lack of segregation of duties, that will also create a risk. Next, unauthorized changes, failure to make necessary changes to the system whenever it is required, and loss of data. So all these are some of the risks that you will face in the use of information technology system. Next, audit of different items of financial statements, which is basically a huge chapter. Most of the CA inter students, they will take this chapter as choice, right? So don't take this choice because I have given a chart book for this particular chapter. In that chart book, complete concepts of this entire chapter I have covered in the form of beautiful colorful flow charts. So you at least read those flow charts, you will not feel that the chapter is very huge. Okay, complete chapter I have covered in just some 15 or 20 pages. I have covered it. Okay, you go through that flow charts because you will get at least 10 to 15 marks from this chapter alone. You should not take this particular chapter as a choice. Okay, so from this chapter, important concepts are: firstly, audit procedures with respect to employee benefits. So, with respect to employee benefits, you have to obtain understanding of entity's process of capturing employee attendance. So, the salary that you pay to the employees, it depends on how many days they have attended the company. Correct. So, how the company is capturing the attendance of employees, that needs to be seen. Most of the companies, they will be having a separate device, attendance device, through which they will capture the attendance. Right, that should be linked to the uh, data from that attendance software should be taken while calculating the payments to the employees, right? Next, there is always risk that entity could record expenses for fictitious employees. So entity might be having 50 employees in the organization, but it might show in the books of accounts that there are 100 employees and we have made salary payment to 100 employees in order to avoid tax. Understanding, if you show more salary expenditure, profit will reduce. If profit reduces, tax amount reduces. So to do that, entity might be showing some fake fictitious employees. We should check that also. Next, obtain list of employees as at period end along with monthly movement split. Movement split means new employees will be joining and existing employees will be leaving the company, correct or not? That movement split you need to see. And for a sample of new hires, obtain appointment letter and verify whether the salary for first month and subsequent months was as per the agreed terms. So for the newly hired employees, you need to select some sample of newly hired employees and check whether the salary payments that are made to them is as per the agreed terms. There will be employment agreement na, as per that agreement only you are paying the salary to them at that rates only or not, you need to see. Next, for sample of resigned employees, you need to ask for full and final payment calculation. So when the employee leaves the organization, you might have to pay gratuity and some leaves he might encash, right? Final settlement calculation will be calculated. So auditor needs to ask the company to give that final settlement calculation. Next, obtain monthly salary register for all the 12 months. Verify if accrual or provision has been made for all employee benefits and obligations like bonus, gratuity, leave encashment, etc. Generally in the month of March, he will provide provision for the salary payment of March month, because generally you will pay the salary in the April month, which is related to March month, right? March month salary you will pay in the April month. So in the March, on 31st March, you will prepare financial statements. So as on 31st March, you need to provide the provision for all the employee benefits, whether that provision has been made or not. And in case of PF, ESI, and other deductions that the company has made, whether these have been properly deposited with the respective authorities, you need to check with the monthly deposit challans. Next, Perform analytical procedures to obtain audit evidence as to overall reasonableness of the employee benefit expense. Analytical procedure means I have already explained you while discussing SA 520. So there are, in the P&L statement, employee benefit expenditure has been shown as 1.2 crore. Okay, 1.2 crore has been shown as employee benefit expense. Now you will ask the company, how many number of employees are there? Company said there are 100 employees in the organization. What is the average salary that you are paying to them? Let's say company says we are paying 10,000 average salary for them. So 10,000 multiplied by 100, it becomes to 10 lakhs. Like this, you will pay for 12 months, right? So total it will become 1.2 crore, which is matching with the amount that is shown in the P&L, correct or not? So here you haven't vouched each and every expenditure. Instead, what you have done, you have asked for non-financial data, that is number of employees, and financial data, that is average salary. By comparing the relationship between them, you have verified the correctness of amount. This is nothing but analytical procedure with respect to employee benefit expenditure, which you need to perform. Next, concept number 20, with respect to details of binomy properties held. Now what is meant by binomy property? If for any property, let's say land, payment is made by one person, and that property is registered in the name of another person. Let's say Mr. A has paid the payment for the land, purchase of land, but that land is registered in the other person name, then you will call it as binomy property, right? So if at all there are any such binomy proceedings pending against the company, following things needs to be disclosed. See, details of such property including year of acquisition, amount of that property which is involved in binomy proceedings. See, if any such type of binomy transactions are conducted, it is illegal. Okay, you will be punished under prohibition of binomy property transaction act. Next, details of beneficiaries. If a property is in the books of accounts, then reference to the item in the balance sheet. If that property against which binomy proceedings are pending is shown in the books of accounts, then a reference to that property should be given. If property is not there in the books of accounts, then fact that it is not stated in the books of accounts should be stated. Next, where there are proceedings against the company under this law as an abettor of the transaction or as a transferor, then details should be provided. So if there are proceedings against the company, that company is involved in the binomy transaction either in this position or in this position. Understanding? Here Mr. A will be beneficiary, ultimate beneficiary, and Mr. B will be binamidar, right? Because payment is made by Mr. A, so whatever the benefits comes out of the property, they will be taken by Mr. A only, so he is beneficiary. But the property is held by Mr. B in his name, so he will be treated as binami dar. Got it? Yes. So if entity is acting either as a beneficial owner or as the binami dar, that should be disclosed. Next, nature of proceedings, status of same, and the company's view on the same, whether company will win that proceedings or company will lose that proceedings. What is the view of the company on that proceedings? Proceeding means nothing but case is going in the court against the company for this binomy transaction. Understood? Those needs to be disclosed. So these are the 20 terrific concepts for CA inter audit for the upcoming Jan 2026 examinations. As I have already told you while starting the class itself, there is a high chance that these concepts might be tested by the ICAI in Jan 2026. If not tested in Jan 2026, in upcoming attempts after Jan 2026 attempt, ICI might test these concepts for sure. So this video is not only relevant for Jan 26 students, even for the upcoming students also, this video will be relevant. Got it? Yes. Hope this discussion is useful to you. See, in case if you wanted to revise the complete concepts of all the chapters of CA inter audit, I have already made a marathon. So there is around 20 hours of marathon session where I have explained each and every concept of a CA inter audit. You can watch that marathon session also. I will give link to that marathon session in the I button and also in the description. Okay? Yes. So see you. I'll be winding up this video as of now. We'll meet in the next video. Until then, take care. Bye bye. See you.